Picture this. A decade of relentless effort propels your company to the pinnacle of success, becoming one of the largest unicorns with a staggering valuation of $47 billion. Your achievement is plastered across every digital front page, a resounding acknowledgement of your triumphant startup journey. Having secured a whopping $12 billion from renowned funds like Softbank, JP Morgan, Fidelity, and Goldman Sachs, the world watches in anticipation of your next move. However, what unfolds next is a tale of unprecedented chaos. In a mere 3 years, your world comes crashing down. The once celebrated company is now in bankruptcy, and executives scramble to disentangle the business agreements that led to the precipitous fall. This is the riveting narrative of WeWork, the short-term office space leasing company, and its chief executive officer, Adam Neumann. Let's dive in. I want to start off by discussing the background of the business model of WeWork. The concept was straightforward. Initiate long-term lease contracts with building owners, revamp the interiors with amenities like cafes, offices, and community spaces, and then lease individual areas on shorter terms. This approach appealed to technology startups, freelancers, and small businesses who didn't require space full-time, opting instead for monthly commitments. However, here lies the Achilles heel in WeWork's business model, a risky strategy known as arbitrage. The company basically bet that it could rent out the office space at a higher rate than it was paying. While this model seems logical in bustling locations like downtown Manhattan, the business would be at the whims of the economy. Clients who are on monthly contracts could cancel with short notice, and in the event of economic downturns, short-term lessees could abandon ship, causing WeWork's revenue to plummet, all while they are still obligated to fulfill their long-term leases. The story of WeWork begins back in 2011 with a modest $1 million raise in October 2011, valuing the company at a seemingly humble $2.7 million. In that initial year, WeWork reported $14.5 million in revenue from its office spaces. Fast forward 5 years, and the startup is reporting substantial growth. Revenues had grown to $436 million, enabling the company to raise an impressive $1.7 billion at a $17 billion valuation. The influx of funds fueled the company's expansion, with more long-term leases, increased hiring, and intensified advertising efforts. By the close of 2016, despite boasting over 2,000 employees and telling a massive growth story, WeWork dropped a bombshell, a $430 million loss. However, this financial setback seemed inconsequential to Adam Neumann. Fueled by the acceleration of his business reaching unicorn status and pursuing growth at any cost, he pushed forward, locking in new long-term leases and raising even more money from the likes of Fidelity, JP Morgan, T. Rowe Price, Goldman Sachs, and Benchmark. In the subsequent years, WeWork found an unexpected ally, Softbank, a financial giant with assets exceeding $154 billion, led by the visionary Masayoshi Son. With SoftBank's backing, WeWork forged ahead, rapidly expanding to become the largest private occupier of office space in London and Washington, D.C. Between 2017 and early 2019, SoftBank injected over $5 billion of the $8.8 billion raised by WeWork, catapulting the company's valuation to an astonishing $47 billion. Pause for a moment and consider this. The Burj Khalifa in Dubai cost $1.5 billion, the Mars rover $2.5 billion, and the James Webb Space Telescope a hefty $10 billion. The Human Genome Project a mere $2.7 billion. Even the SoFi Stadium in Los Angeles, a colossal endeavor, cost about $5 billion. To put this in perspective, one of Canada's iconic landmarks, the CN Tower, comes in at an estimated $300 million in today's dollars. This implies that WeWork's value is equivalent to a staggering 157 CN towers. By 2018, WeWork boasted 9,500 employees and saw their revenue ascend all the way to $1.8 billion. But that growth came at a substantial cost. The company that same year saw a loss that was larger than the revenue figure at $1.9 billion. Riding the highs of WeWork, just hitting that $47 billion valuation, Adam Neumann and the company thought the best way to capitalize on this was filing to go public. And that's exactly what they did on April 29th, 2019. But by September, WeWork would pull their public offering. So what went wrong? This marked the first occasion for investors to peer into the financials of the remote work conglomerate, and what they uncovered was far from favorable. The IPO revealed staggering losses, exceeding $900 million for the first 6 months of the year. The numbers spoke volumes. WeWork was burning through an estimated $150 to $200 million monthly. The company was hurtling towards an imminent cash crunch. While the company emphasized a seemingly robust figure, $4 billion in future lease commitments from its clients, it conveniently tried to hide that the company had $47.2 billion in long-term lease commitments that they had made. Diving deeper, the IPO documents unveiled a concerning truth. Many clients could cancel their deals with just a month's notice. Effectively, the business was on the hook for over $47 billion in long-term leases and only had $4 billion of future lease commitments from its clients. Something hilarious, though not entirely related to the story here, is that the word atom appears in the prospectus 169 times. In that IPO, Neumann referred to himself as a unique leader who has proven he can simultaneously wear the hats of visionary operator and innovator while thriving as a community and culture creator, which is a bizarre set of words to call yourself. Speaking of Mr. Neumann, the prospectus exposed numerous apparent conflicts of interest, including Neumann's hiring of multiple family members, rent collection from WeWork on buildings he owned, and a hefty $5.9 million charge for the rights to the trademark on the name We. As these revelations surfaced, WeWork found itself at a crossroads with investors swiftly losing interest. The fundraising process extended and the company's valuation plummeted, with bankers and underwriters pegging the new valuation between $15 and $20 billion. By the end of September, two significant things had happened. WeWork formally withdrew its go public application, and Adam Neumann, the CEO who brought the company to a $47 billion valuation, was out. The unraveling of WeWork, once America's largest unicorn, had just commenced. Pressured by board members, including Softbank representatives, Neumann relinquished majority control after losing support. Yet the business challenges persisted, bleeding hundreds of millions monthly, and with the failed IPO in their wake, WeWork needed a financial lifeline. By the end of 2019, in a desperate bid to push off an impending failure, they secured $5 billion from Softbank and an additional $1.8 billion from Goldman Sachs. Little did WeWork know, raising that $6.8 billion at the close of 2019 would become a saving grace. This is where we stepped into a new decade, with a seismic shift in how people worked as of March 2020, which saw the dawn of a global pandemic known as COVID-19, and it unleashed its havoc on people working at offices. With lockdowns in place and the virus spreading, people found themselves confined to their homes. Predictably, this couldn't have happened at a more inopportune moment. It not only disrupted WeWork's entire business model, but struck after years of the company establishing itself as one of the largest tenants in office buildings. By 2020, WeWork had solidified its presence as a major office space tenant in key cities like New York City, Los Angeles, and San Francisco. In Canada, it stood as the second largest flexible workspace provider, boasting over 1.86 million square feet. In a matter of months, WeWork witnessed its bustling office spaces transform into ghost towns. To rebound, the company undertook a substantial financial investment, placing hand sanitizers, distributing free face masks, and installing plexiglass dividers to instill confidence in people to return to shared workspaces. However, this effort came at a significant cost. WeWork reported a loss exceeding $4.8 billion, over twice what it had reported in 2018. However, the company was in too deep now, and its only choice was to power through the COVID-19 era, hoping to emerge bigger, stronger, and more efficient on the other side. In early 2021, WeWork saw a glimmer of opportunity. They decided to take another shot at going public. Their valuation, though, was going to have to take a hit. The company was now valued at $9 billion. Still a substantial sum and equivalent to about 30 CN towers, but a far cry from the commanding $47 billion valuation it flaunted just 2 years prior. Now, who bore the brunt of this massive drop in valuation? Predictably, it was Masayoshi Son. Softbank faced a staggering $9.2 billion write-down on their $17 billion investment in WeWork. But you may ask, if WeWork is going public, they must be in better financial health, right? They've had a year of the pandemic to realign the business. Not quite. The company continued to bleed money, continuing to lose an impressive $150 million a month. WeWork also reported a substantial 25% decline in revenue. And by the close of 2021, the company's stock price took a downward drift, resulting in a valuation of only $6.2 billion. While revenue did bounce back in 2022, the company found itself with only $287 million in cash and a daunting monthly burn rate of around $60 million. Unsurprisingly, this financial scenario didn't sit well with shareholders, leading to an over 82% decline in the stock over the year, plunging the valuation once again to roughly $1 billion. And in 2023, the situation took a nosedive. In early November, after another significant blow to the company's valuation, dropping below $100 million, WeWork officially filed for bankruptcy as it looked to restructure its operations.
The office-sharing company WeWork has filed for bankruptcy protection. The New York-based company, once valued at $47 billion, is now struggling with debt and trying to get out of long-term leases. WeWork started to crater during the COVID pandemic when demand for office space drastically fell.
The company aims to reject 69 underperforming commercial real estate leases, erasing about $3 billion in debt as part of its proposed reorganization plan. The restructuring will see most existing shares deemed worthless, except for those belonging to Softbank, which is poised to become the owner of the business once the dust settles. So let's wrap it up. Neumann's pursuit of revenue led him to overlook the importance of building a sustainable, cash flow positive business. But the story of WeWork can be summarized like many startups over the last decade. It was a product of low rates, cheap money, and investors looking for any semblance of a return. When the capital dried up, what was built couldn't be sustained, and the house of cards came crumbling down. WeWork is basically the poster child of the era. Its demise was inevitable. Unfortunately for investors and those involved with Softbank, it's simply the age-old hard lesson that if the returns seem too good to be true, they probably are. All right, everybody, thank you for watching. If you could do me a big favor, please hit that like button, subscribe, and ring that notification bell. Let me know what you think in the comment section. So guys, we just recently launched this channel and we noticed that 99.9% of our viewers are not subscribed. So if you enjoyed this video, we need your help in growing this channel. By subscribing, that would help us keep the lights on and make sure that our crews have jobs in these uncertain times. So please hit that subscribe button, and we promise to make more quality videos that I'm sure you're going to love.